My company has the option to make some 401k contributions as Roth 401k contributions. How do Roth 401k contributions work? Should I be putting some 401k dollars toward the Roth part or stick to the regular 401k? I'm early career and currently contributing the max to the 401k. Employer contributes through a profit sharing model that I don't qualify for yet because I have to be employed for 2 years plus. Okay, so here's the deal. When you have a Roth 401k option in your 401k, you can choose to put that $19,500 contribution into a tax-deferred or traditional account or a tax-free or Roth account. Now, with the tax-deferred account, you get a tax break up front, the money grows in a tax-protected way, and when you take it out in your retirement years, it comes out at your ordinary income tax rates. If that's your only source of taxable income at that time, obviously you get to use it to fill the tax brackets as you go, right? Some of that you don't have to pay taxes on because of your deductions or the standard deduction. Then some of it's taxed at 10%, 12%, et cetera. A Roth contribution, you pay taxes on it as you earn it. Then it goes in the account, it grows in a tax-protected way. And when you take the money out in retirement, it comes out tax-free. So tax-free sounds awesome, but if you paid, 37% on it when the money went in and could have pulled it out at 10%, well, tax-free isn't quite so awesome. So the general rule of thumb, as I mentioned earlier in the podcast, is during your peak earnings years, contribute to tax-deferred accounts, and in any other year that's not a peak earnings year, contribute to a Roth or tax-free account. You can also do what are called Roth conversions, and these are really popular for people who cut back on their clinical hours later in their career or retire early in between the time they retire and when they start taking Social Security, to do Roth conversions, to actually move money from their tax-deferred accounts into a Roth account and pay any taxes due on it. And then that can help them do some tax planning and have tax diversification during their retirement and hopefully lower their overall tax bill. It can also reduce how much they have to take out in required minimum distributions, which now start at age 72. But you don't have to take those from a Roth IRA like you do from a traditional IRA. Interestingly enough, you do have to take them from a Roth 401k. So if you're approaching that RMD age and don't want to take those RMDs, make sure you roll any Roth 401ks you have into a Roth IRA. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.